Lowe's just reported slightly better than expected earnings. They're the prototypical dividend growth stock, which I've talked about multiple times on this channel, and analysts have upgraded their price targets and buy ratings. So naturally, I decided to sell my position.
Why are you the way that you are?
In this video, we're going to go through my thought process on Lowe's, what I saw on the fundamentals and financials that concern me, and why I decided to keep other holdings in my portfolio that are in a similar position. Okay, so there's a lot to unpack here. Now, if you're a hardcore buy and hold dividend investor, you may be wondering, what the heck is wrong with me? Like, I sold Waste Management, now I'm selling Lowe's, what is going on? Now, I don't really want to be as in and out of positions as I have been with these two, but I'm just trying to make decisions based on what I'm seeing happening in these companies and trying to get my portfolio in a place to where I feel really confident about it going forward. And we're going to get into all that. So a couple weeks ago, I mentioned this. Lowe's was one that I actually bought in December, and they've been one of my better performers, but they're a little bit tough out of all these because I actually think when I look at their fundamentals, they're one of the ones where I'm a little bit concerned as to where things are trending, but they've been such a strong performer over such a long period of time that I'm probably going to give them the benefit of the doubt until something more drastic changes in their business. But that's one that I'm definitely starting to watch. And I just want to start out by saying I love Lowe's. Like, as a customer, I think they have one of the best order and pickup experiences out there. I love their app. I love their emailed receipts. I love shopping there. And as an investor, there aren't very many stocks that have the type of history that Lowe's has, and I've used them as an example of dividend growth on this channel, which is a primary goal of my portfolio strategy. So why did I sell? So there were three primary factors, and we'll go into detail of each, but I'll tell you what they are. 1, debt. 2, margin and macro. And 3, portfolio risk. So let's dive into debt a little bit. Lowe's is one of 2 companies in my portfolio that has a negative shareholder equity value. McDonald's is the other one. But what does that actually mean? So we've talked about how total common equity is kind of like the net worth of a company. It's basically assets minus liabilities, and what's left over is total common equity or shareholders' equity. And to value a company in our discounted cash flows valuation, we use a total common equity number and add it to the present value of future cash flows. And that's the one that I do in all of my stock analysis videos. So I was updating my Lowe spreadsheet since I knew earnings were coming up, and the value was, minus 14 billion something. And it just kind of piqued my curiosity since I hadn't really dug into it that deeply in a while. So I went to go look at shareholder equity for Lowe's, and I saw this. Now, first glance, it's a little shocking. You're like, whoa, what's going on here? But having a negative shareholders equity isn't necessarily a bad thing by itself. You really need to understand the full picture and financials of a company to kind of know whether it's an issue or not. Because there's 2 things that Lowe's has been doing that has been reducing shareholder equity. 1, they've been buying back a lot of shares, which in general is a good thing, and Lowe's has historically done very well at that. And 2, they've been taking on a lot of debt, so much so that long-term debt has doubled in the last 3 years alone. And this is the actual strategy that Lowe's management is taking, where they've said in earnings calls that they want to get to a 2.75 debt to EBITDA ratio. Now, I'm not an expert in capital allocation by any means, right? But as a regular investor, my concern that I would have with hearing a debt to EBITDA ratio like that is that debt can stay on the books for years once you issue it, right? Whereas EBITDA or earnings, that's going to change every quarter, and it's going to be impacted by what's going on in the economy or other issues that might be out of your control. So a 2.75 debt to EBITDA ratio could all of a sudden be a 3 or 4 or 5, depending on what happens with earnings going forward. And when you compare that, 2.5 plus debt to EBITDA ratio to what Home Depot is doing, Home Depot is at about half that. And it's not that one particular number means it's good or bad. It's just trying to get an idea of where they sit compared to their main competition. Now, debt in general isn't necessarily the worst thing in the world. It is financial leverage, but the reason why it's concerning to me is the rate of increase of the debt, basically doubling over the past 3 years, and the relatively low margins that retail companies like Lowe's happen to play in, combined with a potential slowing economy, which brings me to my second point. Number 2, margin and macro. Now, when you look at the free cash flow margins for Lowe's, you can see that they're relatively low, which is what you would expect a lot of times in retail companies. And if you look at Walmart's, they're even lower. The challenge with low margin businesses is that there's just less room for error on the revenue side without materially impacting your income and cash flows. Now, obviously, there's always things you can do to reduce costs or try to improve margins, but in general, you're heavily dependent on keeping that revenue growing and steady. When I look at Lowe's trends as it relates to revenues and cash flow, it's at best decelerating, but looks to be more flat and in some ways declining. Lowe's had revenues up over 11% for the quarter, but they were down 9% year over year, which is important because revenues are generally seasonal. And that showed up in the comparable sales being down 1.6%, and they've already said that they expect it to be -2 to -4% for the year. So any way you look at it for Lowe's, at least right now, their revenues aren't growing. But even with revenues down, in terms of free cash flow, they had a really good quarter, which was helped by a nice bump and change in inventories. Now, was that something that's going to continue? Was that a one-time thing? I'm not really sure, but the declining revenues definitely concerns me. Add that to the fact that there's a chance for an economic slowdown and possibly less consumer discretionary spending, as well as an uncertain housing market with interest rates being where they are. And all those things together are what really made me start to feel uneasy about my Lowe's position. Now, ultimately, Lowe's has been able to still hit their numbers and have their stock perform over a lot of years because of good management decisions and because of the leverage that they've taken on and managed well so far. But at what point is the rising debt and declining revenues an issue? I don't know. But that brings me to my third and final point. Number 3, portfolio risk. So in addition to Lowe's, I have 2 other companies in my portfolio that I feel like are kind of in the same ballpark. One is McDonald's, who's also a consumer discretionary company, and they also have negative shareholder equity because they're using the same strategy of increasing debt that's helped to kind of juice up their returns. And then there's Walmart, which is also a retail business with very low margins, lower than Lowe's actually, and they also have quite a bit of debt themselves. But here's why I feel better about those positions than I do about Lowe's. McDonald's is a higher margin business by quite a lot, so there's more room for error. And I think they have a stronger outlook in terms of dealing with economic headwinds. I don't think McDonald's is going to be hit as hard by an economic slowdown as Lowe's will be. And that's actually played out a little bit in the recent revenues that we've seen. McDonald's was up over 10% for the quarter, but more importantly, up 13% year over year, because again, revenues tend to be seasonal. And when you compare that to Lowe's, even though they were up 11% for the quarter, they were down 9% year over year. And if we compare that to Walmart as well, my outlook for Walmart is also more favorable than it would be for Lowe's, because if we happen to have an economic slowdown, people are still going to need groceries, are still going to need household products. So I don't think it'll be hit as hard as Lowe's would be. Now, Walmart's margins are quite a bit lower, but they're still growing revenues. Walmart was up over 6% for the quarter and 5.7% year over year in revenue growth. And I've talked about it multiple times, how their whole strategy right now is to grow that margin and increase income and free cash flow faster than revenues. Plus, another benefit that Walmart has in terms of financial strength is its credit rating. Walmart is AA rated by S&P Global, while Lowe's is BBB+. And you might be like, okay, but why does that matter? It matters because it affects interest rates that they have to pay on any debt that they issue. And you can see that in the financial statements. Both Lowe's and Walmart issued new notes recently, but the interest rates for Walmart, on average, are about 1% less than Lowe's. Now, ultimately, as long as Lowe's has the cash to cover the interest payments on their debt, which they do, then it's not that big of a deal. But it's just another data point about financial strength against a company that I already have in my portfolio. And so if we look at them all together, we see that Lowe's has the highest debt to free cash flow ratio. And that's basically a number that tells you if you use the free cash flow that they generate, how many years would it take to pay off their debt? And in this case, for Lowe's, it's over 10. When it comes to margins, obviously McDonald's has a huge edge in that area. Walmart is obviously lagging behind both of them, but I think they have strengths in other areas that really kind of make up for it. Because most of the concern that I see is in the revenue growth and the future outlook of the companies. With McDonald's and Walmart, you can see that revenue is still growing and comparable sales as well. Whereas with Lowe's, it's negative for both. And with the overall health of the economy and housing market being uncertain right now, it puts even more doubt into those numbers, at least in my opinion. And so when I look at Lowe's in terms of the 3 main criteria I use to analyze stocks, it really breaks down like this. From a business perspective, Lowe's is obviously a duopoly with Home Depot, but they're seeing declining revenues and an uncertain economic outlook. So normally I would say business in general would be strong, but now I would kind of downgrade that to just being okay. In terms of operational performance, obviously Lowe's has had a long-standing history of excellent performance, but the rise of debt over the past 3 years has me a little worried. So again, this is something I would probably downgrade a little bit to be just okay. In terms of valuation, if we take a look at the updated discounted cash flow sheet for Lowe's, even with what I consider to be a pretty generous 8% starting free cash flow growth rate. Obviously, I'm using the calculated number here in the sheet, but if you look at the projected growth rates for Lowe's, in most cases, they're negative. But even with that 8%, the fair value price per share is still only $115.60, which is a little more than half than what the stock is trading at today. So in terms of valuation, I almost have to rate it as poor. Don't overreact about the valuation score. I think there's multiple companies in my portfolio that the valuation score would be poor right now, and that's okay. I mean, ultimately, there's three aspects to my decision making, and sometimes the business aspect and the operational performance aspect are really the most important one. And then valuation is more a question of, am I getting a good business at a good price or not, or am I paying a premium for it? So between the rising use of financial leverage, the low margin business, and the potential economic slowdown that could impact top line revenues even more, I had a lot of concerns with my Lowe's position. So I ended up selling at $225.32 for a little over an 11% total gain. And to be clear, I didn't have to sell necessarily. I could have just held and waited to see if it turned around because Lowe's has been such a good performer. But because I already had two companies in my portfolio that had a similar risk profile, I felt it was a good idea to reduce the overall portfolio risk. But this is a really good example of how our own individual situations play a part in our decisions. Like what makes sense for me may not make sense for you based on what you have in your portfolio or what your goals are. Obviously, time will tell if this ends up being a good decision or not. And I'm not against adding Lowe's back into my portfolio at a later point if conditions change or they get that debt under control, but it just looks a little bit riskier to me than people are talking about. And maybe that's because I don't know what I'm talking about. But I've decided to go against 60 years of history and outperformance. So we'll see. Hope you guys have a great day out there. Financial independence is true freedom, so keep building and stacking wins. And I'll see you guys in the next one. Peace.